Greetings, everyone, and welcome. It's a pleasure to have you join us for RBS Auditors Corporate Tax Webinar Series Part 9. I'm Anjali, your host for today's session, where we'll be discussing the free zone tax impact. This webinar will be conducted in 2 sessions. The next session will be announced soon. Before we dive into the topic, let's take a moment to extend our warmest wishes to everyone on the occasion of UAE National Day. As we celebrate this day, we are excited to share valuable insights to help your businesses navigate the latest tax developments. In today's session, we will focus on free zone tax regulations overview, qualifying free zone exemptions and conditions, corporate tax return calculation, compliance and reporting requirements, along with practical examples. We encourage you to actively participate by sharing your questions in the comment section. Depending on the time availability, we will either address the questions today or cover them in part 2. If you have missed our previous sessions, we'll invite you to explore them on our YouTube channel. Please feel free to share your feedback through comments or a Google review. We have muted everyone's microphone as this is an online webinar. Now let us warmly welcome our esteemed speaker, CA-CFE, Mr. Sijin K. Ravi, who will guide us through these important topics. He is a recently qualified tax agent, and we are expecting to be listed in FTA portal soon. Over to you, sir.
Thank you, Anjali. Thank you, Anjali, for giving a brief introduction about today's topic. Good morning, good afternoon, good evening. This is our 9th webinar series relating to corporate tax. In this webinar series, we are mainly focusing on free zone tax. It's a 2-part, part 1 and part 2. Part 1, it is basically into the basic introduction related to corporate tax, how it will be applicable for a free zone, and part 2 will be a detailed analysis of each industry-wise. So after attending this webinar, you should be able to know that what are the free zone, which free zone will be eligible for a 0% CT, whether it is a designated free zone or it is a free zone, whether it will eligible for 0% CT. Then do I maintain 2 documents in order to get a 0% CT? Then whether the company is eligible to get 0% tax, even if I am not doing any qualifying activity. And finally, you can decide whether you are eligible for 0% or you can opt for 9%. So let's share my presentation first. So agenda for this session. So we'll discuss about the definition. Then we'll discuss about the tax rate. We'll discuss about the key conditions, juridical person, then non-juridical person, then free zone person, then scope of the qualifying free zone person, then SIGA, then non-eligibility category, SBR, then laws, tax group, then immovable properties, then de minimis requirements, then CT return content. So CT return content applicable to the free zones. Now let us look at what law will be applicable for the free zone. So Corporate Tax Law 47 of 2022 on taxation of corporation and business, it contains 2 articles, Article 18 and Article 19. Article 18 and 19 talks about the free zone person. Then they have issued 2 cabinet decision, 1 cabinet decision 55 and ministerial decision 139 of 2023. Then the entire cabinet decision, all the decision has been removed and replaced with the cabinet decision 100 and ministerial decision 265. So now look at a cabinet decision 100 and ministerial decision 265 2023 in order to understand the business of the free zone. So CT law 47, it is relating to the entire taxation of corporation and business. Out of this article 18 and 19, it specifically says about free zone taxation. So let's look at the tax rate. So there are 2 tax rates. One is a standard rate and the second one is applicable for a qualifying income. What will be the tax rate? So if you are in a free zone person, then the tax rate is a 0% on a qualifying income. Certain conditions are there, only it's relating to a qualifying activities. Then other part is like a 9% tax will be there if it is a non-qualifying income. You are conducting any activity with a non-qualifying income, then that income will be taxed at 9%. And if you just to see this area, there is no standard deduction of 375,000. Come to the standard rate, it is one is a 0% rate. That means up to 375,000 dirhams, it's a 0%. Then above 375,000 dirhams, it is taxable at 9%. So this is one is a standard rate. This is applicable for a non-free zone persons, or you have a free zone, but you are opting only for 9%, that this will be applicable. And now the main part, it is like what is a free zone and what is a designated free zone. So if you come to know that there is a two category of free zone, one is a designated free zone and the second category, it is free zone. So designated free zone means a free zone designed by, designated by for VAT purpose. That means having a custom borders and everything, wherever the free zone having a custom borders and everything, that free zone is treated as a designated free zone. For example, in Abu Dhabi, there are 5 free zones like Khalifa Port, Al Ain International Airport, Khalifa Industrial Zone, Kizaz. In Dubai, it's a 9, then Jafsa, Dafsa, then like that. Then Hamria, Ajman free zone, Al Quwain, in Iraq free zone, Fujairah free zone. Like 27 free zones are there in their designated free zone. So if you go to the FTA website, you can download the list of designated free zone. Then you can check whether your free zone, your company is whether under designated free zone or not. And second category of free zone, it is other than designated free zone. So it is mentioned in a law itself, they have mentioned designated and defined geographic area. That means it's just for an area. It's not relating to designated as per VAT, but it is just an area that is a separate area. For example, DIFC, ADGM, all these free zone, DMCC, DSO, all these free zone are treated as just a free zone, and other free zone like 27 free zones is treated as a designated free zone. So this classification you should know very well. Then only you will get a comparison whether you will be eligible for 0% or you will be eligible for 9%. Now, all taxable person should check whether their respective authority to confirm if they operate in a free zone or designated free zone as per VAT calculations. Now let us look at the definition under Cabinet Decision 100. So Cabinet Decision 100, it says about one is relating to domestic PE. PE means permanent establishment, a place outside the free zone in the state. State means UAE. So whatever the place outside in the free zone, then it is called a domestic PE. Then there is a qualifying activity. That is, qualifying activity is defined in Article 2 of Ministerial Decision 265. Out of these, 14 activities have been defined. Then there is a excluded activity that is defined in Article 265 as per Article 2. Then there is a non-free zone person who is not a free zone person. It is called a non-free zone. Then commercial property used exclusively for business purposes is treated as a commercial properties. Then a designated zone, what we have just now discussed, designated zone as per VAT Law 8 of 2017. Then law number, corporate tax law 47 of 2022. Then IP, patents and copyrights. So whatever the laws as per different foreign jurisdiction, it is treated as. So these are the main definition in Cabinet Decision 100. And moving to the next one, it is relating to ministerial decision. So ministerial decision, it is entirely different from the cabinet decision. So what ministerial decision, they have given little more elaborate relating to some of the areas. So one is relating to qualifying commodity. They have specifically mentioned what are the qualifying commodities like metal, mineral, energy, agriculture commodities that are traded in a recognized exchange in a raw form. So if you are trading in a raw form, if you are doing any processing of this metal or minerals or energy, then it is not treated as a qualifying commodity. If it is in a raw form, then it is treated as a qualifying commodity. Then there is a recognized exchange. That means a commodity exchange like ADGM, DIFC, like that. Then there is a definition for ships. Ships means a normal, whatever the ships. They not specifically mentioned about the tonnage or anything. Then aircraft, that is a normal aircraft definition. Then there is a competent authority that like a central bank, DIFC, ADGM. Then law number, corporate tax law 47 of 2022. So there are two definitions are there. One is relating to cabinet decision, and the second one is relating to ministerial decision. So you have to club all these two definitions and see that what are the some of the different definition. It's purely for designated zone, and some of the definitions it's purely for non-designated zone. For example, let's see. Metal, mineral, energy, and agriculture, it is traded in a recognized exchange. That means a DAFC or ADGM. So it is ADGM or DAFC. It's not a designated zone, designated free zone, but it is a free zone. Still, they will get a 0% tax. So who is a free zone person? So one category, only juridical person can become a free zone person. So juridical person means a person incorporated, established, otherwise registered in a free zone. That means a simple meaning means it's a legal setup, either a branch or a non-resident person registered in a free zone. So qualifying free zone person has been defined in Article 18 of the law, and it says that either a foreign or UAE juridical person that have a registered branch in a free zone or a free zone authority or government controlled entity established in a free zone. So even if it is a government controlled entity, if it is established in a free zone, still it is treated as a free zone person. And which is not considered natural person, it is excluding. That means it's not considered as a free zone person. If you are a natural person, then it is not treated as a free zone person. Unincorporated partnership, then sole establishment. So if it is a sole establishment, unincorporated partnership, natural person, then this free zone taxability, it will not applicable. So even if it is a head office in the free zone or branch in the free zone and a foreign company branch in the one of the free zone, then still it is treated as a juridical person. And if you are satisfying the first condition, you are selecting of which free zone, whether it is designated or other free zone, then whether you are a juridical person, then next moment it is relating to whether you are doing a transaction within that certain activities. So if it is in a prescribed geographical area, some of the activities they are specifically mentioned, it's only in a distribution, only in a designated free zone, then only you will get eligible for 0%. For example, distribution activity. If you are meaning in a goods or goods and materials, and that goods and materials, if it is in a designated free zone, then only you will get a 0% corporate tax. Otherwise, it will be 9%. So, for example, JAPSA having a designated free zone, and DMCC, it is a non-designated free zone. So, if you are doing a trading of distribution activities in DMCC, like buying or selling of goods and materials, you will not be eligible for 0%, because distribution activity, they specifically mentioned that, saying that it should be routed only through designated zone. Rest of the activities you can do other free zones also. So one is a designated free zone person. Second one is a qualifying free zone and a free zone person. That means one free zone with another free zone. So if you are interacting with the one free zone to another free zone through a beneficial recipient, that beneficial recipient means not a natural person. So you are interacting with the B2B transaction, then you will eligible for 0%. Then designated free zone, they have mentioned designated free zone as per VAT law. Now it's a qualifying free zone person. Who is a qualifying free zone person as per Article 18? So there are 6 categories, conditions in order to become a qualifying free zone person. One is relating to substance. So maintain adequate substance. That means substance in the free zone or designated free zone in case of a distribution, that's specifically at all. And the second one is relating to qualifying income, that it derive income from qualifying activity. And third one is not elected as 9% tax. That means you are not elected as a 9% tax, means you are electing as a 0% tax. Then fourth one, comply with the TP, transfer pricing regulations. So that means you have to maintain transfer pricing documentation, then transfer pricing records and everything. So transfer pricing, it says that Article 34 and 55, it says that MNEs companies, if the global turnover income is 3.15 billion or more, or consolidated revenues are 200 million or more, then it is you have to strictly follow transfer pricing rules and regulations. Or your transaction with the related parties, it's 40 million aggregate value of the transaction, then you have to maintain transfer pricing documentation. Or you are doing a transaction with a connected person, each transaction exceeds 500,000. So even if it's a salary part, if each transaction exceeds 500,000, then transfer pricing documentation is required. Then next category is audited efforts. Then this audited efforts, it is like even if the revenue is less or more, whatever it's the case, you must maintain audited efforts. But in the mainland companies, it's a 50 million and more, then only mandatory audited efforts. But for the free zone category, it is mandatory, even if the revenue is regardless of the revenue. And sixth condition, de minimis requirement. That means a free zone person, non-qualifying revenue does not exceed 5% of the total revenue or 5 million, whichever is lower. So if this 5% is whichever is lower, that category de minimis requirement will check. Then if all these conditions are satisfied, then you can eligible as a qualifying free zone person, and you can eligible for 0% tax. So what do you mean by adequate substance in the free zone or designated free zone? So condition for core income generating activity. One is a substance in the free zone throughout the year. That means, for example, first year opening balance itself for 20 employees, and the middle of the year it has been only one employee. Then end of the year again maintain at 20 employees. Then it is not possible to treated as a substance in the free zone, because you have to maintain throughout the year. And the second one is a core income generating activity. That means perform core income generating activity within the free zone or designated free zone. Then third one, it is relating to adequate asset must be there. Adequate asset must be there. Then qualified employees must be there. Then operating expenditure must be incurred in the respective free zone. So if it is a designated free zone, then the expenditure must be incurred in that designated free zone. Then only substance you can show it. Then revenue category, essential and value adding activities performed to generate revenue. So you have to demonstrate that the revenue has been generated within that region. Then employees must be free zone employees. Free zone person must ensure that the number of full-time qualified employees is adequate. Then separate SIGA. A separate substance is required for SIGA. The same employee cannot be counted double. That means, for example, if you are doing a mixed work, one for a critical for core income generating activity and some for other ancillary activities, then you cannot compare, because you cannot count one person in both the activities. So you must be very careful with this number of employees category. So we'll see one by one example. Then we'll see that how the substance, how to prove that the substance is there. And the free zone person, if it is outsourcing, then SIGA must ensure that proper person may be located in that free zone and a designated free zone, and the proper supervision must be there in that location. Then only it is treated as adequate substance in the free zone. So deriving qualifying income. For example, in case of a tax startup company, so in the initial stages, if the free zone it is located in the designated or free zone person, but they are doing a qualifying activity, but because of the initial startup stage, they are not generate any revenue. Whether they will get eligible, still they will get an eligible. That doesn't mean that to derive the revenue, then only you can claim the 0% tax. Still they will get eligibility. That means even for a startup company also, they will get eligibility, but you have to ensure that they are not conducting any excluded activity. That means other than qualifying activity, if you are conducting, then whatever, even for a 1 dirham, you are conducting a excluded activity, the entire benefit will be going for a 5 years term. So let's see one example. A free zone person with no revenue in its startup stage. Company F, a qualifying free zone person, was incorporated on 1st January 2024 in a free zone to manufacture environmentally friendly products. That is a manufacturing of goods and materials. It's one of the qualifying activity. It follows the calendar year as a tax period through 2024 and 2025 tax period. Company F remains in a preparatory stage. That means the initial startup stage, facing equipment, purchasing equipment, then hiring of staff, finalizing its product development and everything. And the company does not earn any qualifying income as it's a qualifying activity of manufacturing, and is not in fully operational. So no revenue arise during the year 2024 and 2025 tax period, even though the company has incurred expenditure. So in this scenario, whether is the company is eligible to 0% city. So company F can retain qualifying free zone person status till in 24 and 2025, provided that they should not engage any excluded activity. So they can file the return as a qualifying free zone person, and still they can treat it as a qualifying free zone person. The only thing is that they should not involved in any excluded activity. So whatever the example we have seen in the previous slide, example 1, the facts are remain the same. Only one category, there is a minor change. That is, a company F sells an office chair to an employee for AED 100 dirhams in a year 2024 tax period. So what will be the impact? So sale of office chair, that means 100 dirham, the amount involved, it's just 100 dirham. And this is a revenue from excluded activity. That means you are interacting with natural person. You can see the first previous slides. It has mentioned that you have to do only with the juridical person. If it is a natural person, it's an excluded one. And person involved, natural person. So it is an excluded category. Type of activity, exclude activity. De minimis will be 5%, exceed 5%. That means 100 divided by 100 into 100, it's 5%. And this company will be disqualified from the free zone. So what will be the impact? 2024 will be disqualified. Then next 4 years will be disqualified. Then whatever the income received will be taxed at a straight away 9% without having standard deduction. So city at 9%. So free zone tax, how it will be calculated. Company L, a qualifying free zone person, conducts a business through its free zone parent, business with a free zone parent and multiple foreign permanent establishment. So permanent establishment, nothing but it is just a branch either in the domestic area, either in the mainland, that is called a domestic PE. If it is in a foreign entity, foreign country, then it is called a foreign PE. So foreign permanent establishment and domestic permanent establishment. So they have a foreign PE plus domestic PE. And it derives within arm's length expenses and arm's length allocation, expense allocation. And these are the data, like free zone parent, total amount is 1 million, and all income as received from all qualifying income. And domestic PE, it's 500,000, and foreign PE, it's 5 million. And the company L elects Article 24 foreign PE exemption. So Article 24 foreign PE exemption, it says that you can elect a foreign PE exemption, that you are not taxed, you are not including branch income into your business, and you are giving election for Article 24, saying that I'll be electing like a foreign PE exemption. So foreign PE, once a foreign PE exemption is included, then you need not to include all the incomes of foreign PE, similarly all the expenses of foreign PE into your tax computation. So that is the criteria. So what will be the corporate tax payable? So tax computation. So qualifying free zone person, qualifying free zone income, it's 1 million, and the tax, it is straight away, it's 0%. And the domestic PE, it's 500,000. So domestic PE means a branch situated in the free zone. That one has straight away tax rate 9%, and you have to pay 45,000. So foreign PE exempt under Article 24. So the 375 threshold will not applicable for qualifying free zone person. So under Article 24, foreign PE election applicable only when the tax in another country is more than 9%. So let's say in France having a tax rate of 15%, then you can straight away you can avail Article 24 foreign PE exemption. So one more example to understand how the tax is calculated. For example, company M, a qualifying free zone person, conducts its business through its free zone parent and through a domestic permanent establishment. Company M's total net interest expenditure is 36 million, and they have given the EBITDA given below. One is adjusted EBITDA, total 72 million, and domestic PE EBITDA is 42 million, and qualifying free zone EBITDA is 30 million. And net interest expenditure, that means expenditure minus your income, then that is total, it is 36 million, and the domestic PE is 27 million, and qualifying free zone person is 9 million. So calculate general interest deduction under Article 30. So interest computation. So under Article 30, there is a two clauses, EBITDA you have to take, then EBITDA of domestic PE. You should not take a EBITDA of the total, including the qualifying free zone. EBITDA of the domestic PE you take 42 million and apply 42 million 30%, then or 12 million. 12 million is the threshold as given, and total. So you'll get 30% of 42%. It's a 12.6 million. So whichever is higher, you can get a claim. So company M may deduct net interest expenditure of 12.6 million in determining taxable. So in this case, the net interest expenditure, if it is instead of 27 million, if it is a 9 million, then what will be the interest? Then if it is a 9 million, then general interest deduction will not applicable, because a minimum threshold is a 12 million and above. Then only general interest deduction will be applicable as per Article 30. Then next one is a qualifying income. So we have discussed mainly about the qualifying income, qualifying activity, then excluded activity. So what are the activities treated as a qualifying income? So if you are doing an income from a qualifying activity, then whatever the income received, it will be taxed at a 0%. So we will see that what are the activities will be treated at a 0%. So transaction with the free zone person that are beneficial recipient, that means you have a free zone company and you are doing only with another free zone company, then you will get a benefit, and not excluded activities. So if you are doing a qualifying activity or transaction qualifying activity or any transaction with a free zone person that are beneficial recipient, that means a company to company, whatever the transaction you are doing only in a free zone, you will be eligible. And the second category, transaction relating to non-free zone, but only with the qualifying activity. So one is relating to transaction with a free zone, you can do any activity, including qualifying activity. And if you are doing for a transaction with a non-free zone, that means a mainland, if you are doing any transaction with the mainland, then do the transaction only whatever the activities listed in the 14 activities are listed in the qualifying activity. If that 14 activities are listed in the qualifying activity, if you are doing that activity with the mainland, then still you will eligible for 0%. Then income from ownership or exploitation of qualifying intellectual property, then any other income provided, de minimis requirement are met. This is a provision as per the Article 3 of Cabinet Decision 100 of 2023. So one is you do a transaction within the free zone with the beneficial recipient must be a juridical person and not relating to a qualifying activity. Or if you are doing with a mainland companies, non-free zone person, but only with a qualifying activity. So we will see what are the qualifying activity. Then still you will eligible for a 0% tax. So what are the qualifying activity? So there are 14 categories of qualifying activity. One is relating to manufacturing of goods or material. Second one is a processing of goods or material. Then trading qualifying commodities, holding of shares and other securities for investment purpose, then ownership, management, operation of ship, ownership, management and operation of ships, then reinsurance services that are subject to regulations, then fund management services that are subject to regulation, wealth management services subject to regulation, then headquarters services to related parties, treasury and financing services to related party, financing and the leasing of aircraft, then distribution of goods or material in or from a designated zone to a customer that resells such goods or materials or parts from a designated zone. That means the distribution of goods and materials only from designated zone, then only it is treated as a qualifying activity. Logistics services, any activities that are ancillary to any of these categories. So these are the 14 numbers. So 14 categories of qualifying activity. So if you are doing any transaction with the mainland companies, out of this 14 category, if you are doing any one of these category, then you will be eligible for 0%. If not, then you will not be eligible. And a distribution, it's clearly mentioned that a distribution only in a designated free zone. A designated free zone means a designated free zone as per VAT law. So non-qualifying income. So income from the following source will not give rise to a qualifying income. For example, it will be included in the calculation of the taxable income, and that income will be taxed at a 9%. That is, one is relating to income attributable to domestic PE. So whatever the income generated from the domestic PE, then a domestic PE transaction straight away taxed at a 9%. If it is income from a foreign PE, that means a foreign branch, then straight away it will be taxed at 9%. And income from immovable property other than commercial property in a free zone, and when the transaction with the free zone person, that means again it's a beneficial recipient, then that will be taxed at a 9%. Then income from IP other than qualifying income from qualifying IP. Then taxable presence outside a free zone is referred to as a domestic or foreign PE. That means if a branch situated other than free zone, then it is mainland, that it is treated as a domestic PE. If the branch is situated in a foreign country, it is called as a foreign PE. Let's see one example to understand how this law is working. Company ABC is a law firm. A free zone person performs a legal service solely for a free zone person who are the beneficial recipient of those services. That means a company A is situated in, let's say, DMCC, and they are giving services only to that free zone, only to the company. So whether they will eligible for 0% CT, even though they're qualifying, it is not listed in the any one of the qualifying activity. Can ABC claim a 0% CT? Transaction between free zone person are not required to be with a scope of qualifying activity benefit, and 0% corporate tax rates will be still, you will be eligible. And consequently, income from companies ABC's transaction will be qualifying income, but they should not do any excluded activity. For example, in this scenario, it's a company situated in a DMCC, it's a non-designated free zone, but they are transacting with another juridical person, then they will be eligible. If they are transacting with a natural person, then it is treated as excluded activity, then they will not be eligible. And if same company, if they are doing a transaction with a mainland company, then they will not be eligible, because 14 activity, legal service is not one of the 14 activity. So this is the situation relating to 0% tax. So what is the excluded activities? So any transaction with a natural person except ownership, management and operation of ships, fund management, wealth management, financing and leasing of aircraft. So this transaction, it should be, even if it is you are conducting with a natural person, it is not treated as an excluded activity. But other than this transaction, any transaction you are doing with the parties, then it is treated as excluded category. Another one is relating to banking activity, then insurance activity other than reinsurance, because the reinsurance is one of the qualifying activity. Financing and leasing activities other than intragroup treasury and leasing, subject to regulation. So if you see headquarters business, financing and leasing, it's one of the qualifying activity to related party. So here it is specifically says financing and leasing activity other than treasury and leasing, subject to regulations. Ownership and exploitation of immovable property other than commercial property. So any commercial property situated in the free zone other than the normal one. Then any activity ancillary to this, then it is treated as excluded activity. So excluded activity is there, then it will disqualify that free zone person from free zone tax regime. So who is a beneficial recipient? Because we are talking about the beneficial recipient. That beneficial recipient means a juridical person has a right to use and enjoy goods and services. So he has a right to use, plus he does not have a contractual or legal obligation to supply such goods. That means, for example, an agent is there in between as a middleman, then the beneficial recipient will be the ultimate third party. That will be the beneficial recipient, not the agent. Then what are the income will be treated as a qualifying income from the transaction with another free zone person. If you are doing a transaction with another free zone person, still it is treated as a qualifying income, where other free zone person is a beneficial recipient. That means again another free zone person must be a B2B transaction. And The transaction is not excluded activity. That means if you are conducting a transaction with a free zone establishment is not treated as a juridical person, then it is treated as a natural person category, then it is automatically disqualified. So let's see one example. Company C is a free zone person, is engaged in the business of providing legal services, that is not a qualifying activity. And company C enters into a contract with a company M, a non-free zone person, to provide a legal advice in a Mandarin to company M. So company M situated in a foreign country. And while company C perform legal analysis, company C outsources the Mandarin and other translation work to company D, a free zone person. So there is a transaction. The main transaction, it is between company C and company M. But company M is situated in foreign country, whether this company will be eligible for 0% CT. Whether in this scenario, whether who is a beneficial recipient. So company C is the payment from the company M, which considers a non-qualifying income. Why it is a non-qualifying income? It is one is relating to, it is not a free zone. Company M is not in the free zone. It is a foreign country. And company C is conducting a legal services, which is not a qualifying activity. So automatically it's a non-qualifying income. And company M is not treated as a qualifying free zone person, and it will be taxed at straight away 9%. Income from company M transaction will not constitute qualifying income. And if company D, between the company D and company C. So in case of a company D, if you take a company D is transacting with the company C only. That means within the free zone only. So company D will be eligible for 0% CT instead of company C, because company D is situated within the free zone, and company giving the direct beneficial owner, it is a C, which is again situated in the free zone. So company D will be eligible for 0% CT, not the company E. Next one is relating to CT on a qualifying free zone person without domestic, with the domestic P, example 7. So company J, a qualifying free zone person, derived the following revenue and expenses for the tax period ending 31st December 2024. One is a revenue from a qualifying activity, 1 million. Activities from a domestic P, it is 2 million. Then operating expenses in a free zone, it's 600,000. Operating expenses in a domestic P, that means domestic branch P expenditure, it is 1.4 million. Then HR administrative expenditure within the free zone and domestic, it is 300,000. So company J determined that 50% of these expenses should be attributable to free zone parent. That means operating expense free zone, they have given separately. Operating expense relating to domestic PE, they are given separately. The only condition, it is 300,000 they are given, that they have doing administration, HR administration within the free zone and domestic PE. So you have to calculate complete tax payable for J for the tax year 2024. So first we have to see what is the arm's length principle of the company J to determine the revenue. So revenue, it is 3 million. For domestic PE, it's 2 million, and qualifying free zone, it's 1 million. Then direct expenditure, one is relating to 2 million, domestic PE 1.4 million, and 600,000 for qualifying free zone. Then allocated expenditure, it's 300,000, it's 150K, and both of them, it's allocated 50%, it's allocation, it's already given. And profit, it is a total profit 700,000. For domestic P, straight away taxed at 450K into 9%. So they have to pay 40,500 as a tax. And qualifying free zone person, it's qualifying free zone, that 250, that will be 0%. So it's again, this is based on the assumption saying that there is no other further adjustment as per Article 20 of the Corporate Tax Law. If this case, if he opted for 9% CT, not to claim any qualifying free zone benefit, then his tax liability will be 29,250. That means the total tax is total income is 700,000. He will get a deduction of 375K out of 700,000. Then balance 325K. It's a 9%. So it is better to decide before going an election. You have to decide what are the transactions between your branch, and what are the transactions between within the free zone. So if your transaction between the branch are more, then you have to pay 9% tax on the branch transactions. So you have to decide whether the branch transaction are more or less. If it is a branch transaction are very less compared with the qualifying free zone person's option, then you can select accordingly. So other criteria, we have just now we have seen that 300,000 we have given the like a 50%, we are divided into the qualifying free zone and domestic free zone based on that category. So what are the allocating of expenses? So both qualifying income, taxable income that is not a qualifying income, you need to allocate the expenses between the two parameters. So one is you have to analyze what is a FAR analysis. That means a function, asset, and risk category of the each functional analysis of that entity. Then based on that one, you have to allocate between the foreign permanent establishment or domestic permanent establishment. Then determine the compensating relating to arrangement. That means their respective function, what are the function performed, for example, relating to IT related services. So IT related services, it will be based on the IT ticket raised by the each free zone instead of based on the count, number of employees worked in that company. So if it is HR related transaction, then you can maintain based on the number of employees or the turnover information, like that. So you have to analyze that basis. You can check into the FAR analysis in we have already released transfer pricing of 3 videos. Out of these 3 videos, one of the videos relating to FAR analysis. You can go through that videos, then you'll get a brief idea about how the FAR analysis will be analyzed. Now let us see another example, how the expenses, key independent operation, how the expenses can be allocated. Company K, a qualifying free zone person, has a free zone parent and a domestic permanent establishment. Domestic permanent establishment, nothing but it's a branch, each of which perform independent business and it derives revenue from sale to third parties. So branch is separately independent and the free zone, it's treated in an independent basis. There is no flow of goods between the free zone parent and domestic PE. However, Company K, HR, finance and IT department in the domestic PE support both free zone parent and domestic parents. So revenue is 12.5 million, domestic PE is 12.5 million, total it's 25 million. Number of employees, it's 40 in qualifying free zone and 60 in domestic PE, and total it's 100 employees. Operating expense in a free zone is 600,000, and operating expense in a domestic PE it's 1.4 million, and HR administrative free zone and domestic PE it's 300,000. So you have to calculate how to allocate a common expenses of revenue based on headcount or revenue based. So first we have to see the revenue. It is a 50% between the qualifying free zone and the domestic free zone. So you can allocate the revenue. That means again it's a 40% cost. That means the employees, 40% employees in the qualifying free zone and 60 employees in the other free zone. So 40% cost of HR and finance department, you can allocate based on that basis, HR function. And the IT related function, you can allocate based on the IT support tickets raised by the each free zone or domestic PE. So then you can allocate that expenditure. So that basis you have to analyze. So do I need to all these transactions? Do I need to keep the records? You have to, if you are a qualifying free zone and you are claiming for a 0%, the documentation is more important. And each area wise, not only relating to your turnover information, each area wise you have to keep a record, and you have to put a KYC for the beneficial recipient. And de minimis requirements. So what is called a de minimis requirement? De minimis requirement, a non-qualifying revenue does not exceed 5% of total revenue or 5 million. That means whichever is lower. So if it is lower, whatever the 5% or 5 million, whichever is lower, and if within that range, then still you will be qualifying as a qualifying free zone person. So what are the revenue will be included in these areas? So including for a calculation for de minimis requirement, excluded activities, non-qualifying activities with a non-free zone person who are not beneficial recipients, then IP outside free zone. That means excluded activity, we have already discussed what are the excluded activity. Then non-qualifying activity, the non-free zone. That means you are doing a non-qualifying activity mainland, still you have to include in the revenue category for the calculation of the de minimis requirement. Then free zone person who are not a beneficial recipient, that means you are doing a transaction with a natural person, then that will be considered for included in the revenue calculation. So what are the excluded? What are the revenues you have to exclude for this calculation? One is a foreign PE, whatever the transaction between the foreign PE or domestic PE, that means a branch transaction you have to exclude. Then immovable property in a free zone, not a commercial property, or commercial property but with a non-free zone person. Then intellectual property other than qualifying income from qualifying intellectual property. So if this category of excluded category, straight away it will be taxed at 9%. So if you have a transaction between the domestic PE or foreign PE or any of the immovable property in a free zone, not a commercial property, or non-free zone person, you are interact with a non-free zone person, all this transaction will be taxed at straight away 9%, and these revenues will not be considered for the purpose of de minimis requirement. All these are important. Once we will go through the return filing, then you will understand that why this de minimis requirement, why we want to know more detail about all these things at the time of checking of the return, then you will get an idea. For example, company B, a free zone person manufactures goods in a free zone and it transfers those goods to a domestic permanent establishment. That means it's a P, which then sell those goods for 100,000. That means a branch sells those goods for 100,000. The arm's length price of the goods when they transfer to a domestic permanent establishment is 70,000. That means a free zone person, while transferring to the branch, the whatever the arm's length price, it's recorded at 70,000. So in this case, revenue attributable to company B's domestic permanent establishment will be, that means domestic permanent establishment 100,000 it's to the third party, whatever it is, like that 100,000 less 70,000 it is the transfer cost, transfer from the company free zone person to the branch, and the net income will be 30,000, that will be taxed at 9%. Now let us see what is a de minimis requirement. Company E is a free zone person, derives the following revenue. One is a domestic permanent establishment. So de minimis requirement, domestic permanent establishment, it is excluding category. So that is domestic permanent establishment 10 million. Then a rental from immovable property located in a free zone to a non-free zone person. So this is a non-free zone person, 2.5 million. Transaction with a free zone person who are beneficial recipient of a 200,000 which relate to excluded activity. So total transactions of 5 million, out of 5 million, 200,000 it is relating to excluded activity. Then transaction with the non-free zone person, all are arise from a qualifying activity. So non-free zone person, that means a transaction with a mainland, but all are qualifying activity. Then that is a 2 million. Then other transaction with a non-free zone person, but not qualifying activity. So this is the revenue structure of a company E. Then we have to calculate a de minimis requirement for this company. So how to calculate de minimis requirement? We have already talked the previous slides. So says that 5% of total revenue or 5 million, whichever is lower, then that will be de minimis requirement. Then if it is 5% and more, then you will be disqualified for qualifying free zone person. So we have to calculate what is the total revenue. So transaction with the free zone, but beneficial recipient, then that is a 5 million. Then a non-free zone person, then 2 million. Then non-free zone person, not a qualifying activity, it's 300,000. Total it's a 7.3 million. This is called a total revenue. Then non-qualifying revenue, we specifically says that other free zone excluded activity, out of a 5 million excluded activity is 200,000. So that will be treated exclude non-qualifying revenue. Non-free zone, but it is a qualifying activity. Non-free zone means you are doing a transaction with a mainland company, but with a qualifying activity, then that will not be a non-qualifying revenue. So there is no issue. And non-free zone person, but not a qualifying activity, that will be a part of non-qualifying revenue. Then Total will be 500,000 is a non-qualifying revenue, and 7.3 million is the total revenue. Then the percentage is 6.85%. That means exceeding 5% of de minimis requirement threshold, and company is not eligible for qualifying free zone person status. So once you are mentioned as you are a qualifying free zone person, and once qualifying free zone person status has been selected and you are not eligible, then automatically you have to pay the tax for 9% tax for the first year plus another 4 years. And for this calculation, disregard the permanent establishment 10 million and immovable property located in a free zone, and these two categories are disregarded. And if you see the previous slides, it's like what are the revenue to be included, what are the revenue to be excluded. So you can check that one, then you will get an idea how this revenue has been disregarded. Now, maintaining adequate substance. So they are saying about the SITS category. So one of the category, SITS condition, one of the category is maintaining adequate substance. So what do you mean by maintaining adequate substance? That means the qualifying free zone person must maintain adequate substance in the free zone or designated free zone. Whatever they call designated free zone means a distribution of services that only through designated free zone. And this requires a free zone person to demonstrate that the qualifying activity has been conducted in their respective free zone. And they have to demonstrate that adequate asset must be there, adequate expenditure must be incurred, and adequate qualifying employees must be there in order to generate core income generating activity. So if you satisfy all these conditions, then only that free zone is treated as a qualifying free zone person. So let's see one example. Company O, a free zone person has a warehouse in a designated free zone. So free zone has a warehouse in a designated free zone that uses for a storage and distribution of goods. However, it has a registered office and employees in a free zone. So one company having a registered office in another free zone and warehouse only in the designated free zone. So whether the company or is eligible for a 0% city. So let's take an example. For example, company O situated in a DMCC, it's not a designated free zone, but their distribution activity is conducted in a JAFSA, whether they will be eligible for 0% tax. So SIGA in relation to qualifying activity of distribution must be performed in a designated zone. In this scenario, company O perform the core income generating activity. That means a major head office, everything is situated in a situated in a free zone that is not a designated zone. It would not meet the requirement to have an adequate substance in the designated zone, even though they are in the distribution of materials and goods. But even though they are distribution of material goods in the designated free zone, but the major activity is that the management, head office, registered office, everything is situated in another free zone, which is not a designated free zone, then this company is not eligible for 0% city because the substance is not there in the free zone, designated free zone, that is not eligible for 0% city. Another one, company P, a free zone person, establish a distribution of business in a designated zone and perform all its core coordination activities in a designated zone itself. And the company P does not have any domestic permanent establishment. So there is no branch involved, but all major activities conducted within the free zone. That means a designated free zone. The data says that a designated free zone 20 staff, but outside the free zone, designated free zone 480 staff. Place of business outside the designated free zone, they don't have any PE in the outside the free zone. So in these cases, the activities of 480 staff perform the activity outside the designated zone, contribute to the income of the company, then they would not be considered as a core income generating activity. In case they involve routine delivery execution and do not directly generate any sales revenue. That means nothing but it is like that this is a 480 staff just for doing a distribution of the goods and other thing, and they are not generating every revenue is generated within the designated zone, but for distribution purpose 480 staff has been located in a different place of other than the free zone, then still the 20 staff working in a designated free zone is treated as a sufficient to perform the SIGA. That means for income generating activity, and the company P is eligible for 0%. So the function for analysis is more important before taking as a qualifying free zone option whether you will be eligible for 0% CT or not. So if this scenario, if the activities of any of the 480 employees working outside the free zone to the extent beyond routine execution of activity, that means you can generate revenue from this category, then it is not treated as a not eligible for qualifying free zone person. It's not generating revenue means from the 480 staff itself, they themselves doing a main activity in the mainland companies, then automatically it will be moved. Now let us see immovable property located in the free zone. So free zone person, taxable person. So immovable property in the free zone. Then we'll see whether it is a commercial or non-commercial. If it is a non-commercial property, then taxable at 9%. If it is a commercial property, then you have to see whether you are doing a transaction with a free zone person, then it is taxed at a 0%. If you are commercial property with a free zone person, then it is taxed at a 0%. If you are taxed at a non-free zone person, then it's automatically taxed at a 9%. And immovable property in the mainland, straight away taxable at 9%. Free zone person having a immovable property in the mainland, then straight away taxed at a 9%. And the commercial property means used exclusively for business or business activity, not used for place of residence like a residence building or accommodation, including hotels. So if you have a commercial building, but it's used for a hotel business, then it is not treated as a commercial property. So immovable property, two category, that free zone person, commercial property, office building with a free zone person, with a free zone person, then automatically 0%. But if you are doing with a non-free zone person, then it is taxed at 9%. And non-commercial property like hotels, and if you are doing a non-commercial property with a free zone person or non-free zone person, that means to a mainland, then automatically straight away both the transaction will be taxed at 9%. Even in case of a mixed property, that means some part of the residential building with a retail space, that means generally both qualifying and non-qualifying activity has been generated, then you have to allocate based on the direct allocation, then indirect allocation based on the market conditions, then maintain transfer pricing records and the documentation, then you can allocate the income and expenditure. So company E, a qualifying free zone person has a property located in the free zone company of a 10 floor, comprising of 10 floors. Out of these 8 floors, it's relating to residential apartments, and other 2 floors, it's relating to retail outlet. That means 20%. That are also in a free zone person. Company E receives a total annual rental income of this property of 10 million. So how it is calculated? Company E should allocate income during qualifying and non-qualifying. So total it is a 20%. It's qualifying income, then it is taxed at 0%. Income from residential, then taxed at 9%. Non-qualifying category. So this revenue should not be taken into consideration for de minimis requirement. So summary tax impact. So cabinet decision 100. One is a qualifying free zone person. If it is a non-qualifying income tax at 9%, then income from immovable property located in a free zone from a transaction with a non-free zone person, that means mainland, for a commercial property, or transaction with any free zone with other than commercial property, or income from a domestic PE or foreign PE, then whatever the transaction with branch or a foreign branch, then all will be taxed at 9%. And the qualifying income taxable at 0%. Qualifying income, that means any income from a free zone person, that means you are transacting within the free zone only, then excluding in the excluded category, then you will be taxed at 0%. Income from non-free zone, but that are a qualifying activity. So out of the 14 category, if you are doing a transaction with a non-free zone, that means the mainland companies, but all mainland companies, the transaction only with a qualifying activity, still you will get 0%. And any other income subject to de minimis requirement, then qualifying income from a qualifying intellectual property. So this category, it will be treated as a 0%. Even if, for example, a company situated, holding company situated in ADGM. So within the ADGM, it's not a designated, but it's a holding of shares and holding of shares of the companies. So that purpose for ADGM, company set up in ADGM. So in that case, one of the qualifying activity, but within the beneficial recipient is again, it's a company, then they will be eligible. And ADGM having another investment in mainland company. So holding of shares is one of the qualifying activity, but if if it is holding any shares in the mainland company, then still you will be eligible for a 0% CT, because again, second part, non-free zone person, but you are doing a qualifying activity. So that basis, you will get a 0% tax. Now we will see corporate tax and return for free zone person. So there are two categories. Either you can opt for a qualifying free zone person or not to opt for a qualifying free zone person. So if you are not to opt for a qualifying free zone person, that means 0% tax up to 375,000 and 9% tax above 375%. That means a non-qualifying free zone, not opted category. And a free zone person, qualifying free zone person, if opted for qualifying free zone person, then some of the activities, it's only through designated free zone. Then if they are all activities are within qualifying income, then it is taxed at 0%, and non-qualifying income will be subject to 9%. That means you are transaction with branch or foreign PE, then it is taxed at 9%. And not entitled for 0% up to 0% tax up to 375. So once you selected as a qualifying free zone person, then you will not be eligible for those deduction. Then qualifying free zone person is not eligible for the following. That means there is no small business relief. Once you are selected as a qualifying free zone person, then you cannot elect as a small business relief. It is less than 3 million, then you can claim for a small business relief. That eligibility will not get. Then qualifying group relief, you will not get a qualifying group relief. Qualifying group as per Article 26, it's like a 75% investment in other company. Then no business restructuring relief. So whatever the business restructuring as per Article 27, then you will not get any benefit. No tax loss transfer. You cannot transfer tax loss as per Article 37. Then no tax group benefit. You cannot do a tax group within the free zone. It is not possible once you are selected as a qualifying free zone person. So these are the benefits you will not get once you are selected as a qualifying free zone person. Company N, a qualifying free zone, has a free zone parent and a domestic permanent establishment. That means a branch. Company N renders contract manufacturing service, a qualifying activity, through its free zone parent that generate qualifying income. And company N also renders tech consulting services from its domestic permanent establishment that generate taxable income. That is not a qualifying income. So for the tax period year 2024, the company N reported the following financials. So manufacturing segment, they having a loss of 2 million. That means from a qualifying free zone person. And a tech consulting agreement, they have a domestic PE, they have 5 million. So whether the loss, whether he can carry forward or not. So tax computation, qualifying free zone person, it's a 2 million loss. There is no carry forward of loss. Then domestic PE, we have already discussed. Domestic PE, it's a straight away tax rate at 9%. Then 5 million into 9%, 450,000. And the offset of loss, it is not applicable. Then company N may not utilize any portion of a loss of 2 million relating to free zone parent, and they cannot offset any of the income against 5 million. 5 million, it's a domestic PE. So whatever the 2 million, it will be, they cannot carry forward to next year. So what are the free zone schedule there specifically says about the CT return? One is relating to qualifying revenue. Qualifying revenue, you have to disclose total amount of qualifying revenue. This is just for a disclosure, not for the CT calculation purpose. Then you have to calculate a de minimis requirement, whether you are eligible for de minimis requirement within the range or above. Then you have to do the substance, provide the details relating to the substance of the taxable person, like whether asset, employees, or operating expenditure is incurred in the respective free zone. Then you have to give a confirmation saying that qualifying free zone person, you are meeting all these conditions, and you have to give a confirmation. So there are 2-3 schedules in the free zone schedule in order to get a 0% eligibility. So let's see those things one by one. One is a revenue schedule. So revenue schedule talk about the total revenue as per financial statement. You have to mention about what is the total revenue. Then does the free zone person have a domestic PE or foreign PE? That means whether the free zone person having a branch, if yes or no. If yes, then you have to give a total revenue relating to domestic or foreign PE. And third one is does the foreign free zone person derived revenue from a transaction with a non-free zone person in respect of commercial property. Non-free zone person means again it's with a mainland in respect of commercial property. If yes, then corresponding a revenue. Then immovable property corresponding revenue. Does the free zone derives any revenue from ownership or exploitation of intellectual property? If yes, then you have to give the revenue. Then this will be the total of revenue for de minimis requirements. Then non-qualifying revenue derived from excluded activity, whatever the revenue derived from excluded activity. For example, if you are doing a transaction with a natural person, it is one of the excluded activity. Other than the activities, some of the activities excluding, other than the activities mentioned for category, like a ship, honors, and everything. Then revenue derived from the activities that are not qualifying activity where the other party to the transaction is a non-free zone person. That means you are interacting with a mainland company, but that activities are not a qualifying activity, that will be a non-qualifying. Then revenue derived from transaction with a free zone person that are not a beneficial recipient. That means you are interacting with a non-juridical person, either a natural person, then it is a part of a non-qualifying revenue. Then total non-qualifying revenue will be calculated. Then previous one, we have calculated de minimis requirement. Then you calculate what is a de minimis requirement met. That means again, yes or no. That means you will get a percentage, 5% or less than 5%. Then you will get a de minimis requirement. Then next calculation relating to qualifying revenue. Revenue derived from free zone person, assets for income derived from excluded activity. Then revenue derived from non-free zone person in respect to qualifying activity. That means whatever the qualifying activity, whatever the revenue derived, then qualifying activity is undertaken, then revenue derived from the ownership or exploitation of qualifying activity. This is a qualifying revenue schedule. Then you have to show substance. So if you see the substance, you can see in detailed way they are asked. So one is relating to are all employees located in a free zone? If yes, then you have to give total average number of full-time employees, then total average number of full-time employees located in the free zone. That means that they are actually working in that free zone. That also you have to give. Then total operating expenditure incurred in deriving qualifying income. Then what is a qualifying income? So even if your employees are registered in the designated free zone, but the employees are purely working outside the designated free zone, then it is not considered as a substance in that free zone. So not only the registration, but they have to prove that the qualifying activities have been conducted. Substance must be conducted within the free zone. Then they are asking about the capital expenditure incurred derived for qualifying income. Then having any core income generating activity has been outsourced to any outside provider. If it is outsourced, then name of number of outside providers. Then you have to give a name, address, city, TRN of the outsourcing providers. Then total expenditure incurred on outsourcing providing during the tax period. Then total average number of full-time employees provided by outsourced provider. That means that 20 full-time employees are provided by outside providers. Whether that outside provider is situated within the respective free zone, then only you will be eligible for that one. Then confirmation saying that adequate supervision over the activities of the outsourcing provider. So whether supervision is there in the outsourcing provider services. Then free zone confirmation. You have to give, these are the free zone confirmation. Adequate amount of assets were held in the free zone. You have to give yes or no confirmation. Qualified employees were located in the free zone. You have to prove that qualified employees are located. Adequate operating expenditure were incurred in the free zone. You have to prove that this adequate expenditure is incurred. Then any related party transaction have been undertaken in accordance with Article 34. Related party transaction, Article 34, within the arm's length price, you have to give a documentation relating to that one. Then transfer pricing documentation has been prepared in accordance with Article 55. Article 55 talk about transfer pricing. Transfer pricing documentation. 34 are relating to a different method of TP. Then audited financial statement have been prepared. Then additional information relating to EBITDA, details of EBITDA and salaries and wages attributed to each emirates. Then additional information. So this is a free zone confirmation. Once the free zone confirmation is over, then free zone income from intellectual property. So intellectual property, then you have to give a description of the qualifying intellectual property, overall income, then overall expenditure, then qualifying expenditure relating to qualifying intellectual property, uplift of expenditure, then revenue attributable to qualifying in IP, then income in excess of qualifying income, then total income, then total revenue derived from the ownership and exploitation of intellectual property that is not considered as a qualifying income. So that information you have to give. Once you are given that information, then these are the information asked in the free zone CT return. So instead of the other information, you have to prove that it is a qualified free zone person. You are eligible for 0% free 0% tax, but you have to show that the substance is there. Then corresponding confirmation you have to give. Then employees must be there, all information must be there. Then you will get an idea whether you will be eligible for qualified free zone person. So this is relating to the part one of the seminar. So part one of the seminar, we have basically conducted the base idea about the free zone taxability. So part two we'll be conducting basically the qualifying activity. We have discussed almost 14 qualifying activity that will be detailed analysis of the qualifying activity by industry wise, like shipping industry, then manufacturing industry or processing industry or distribution industry or insurance industry, like that we'll be discussing. By end of this webinar, you will get an idea of whether you have to claim with a 0% city or you have to claim with 9% city. But the main thing is that, for example, you are interacting with the other customers, you have to maintain a KYC for those customers, whether he is a beneficial owner or whether he is an individual or whether he is an establishment. You have to be very careful with the KYC details of the each customers. It's not only the total revenue. You are generated a 200 million revenue, but you have to maintain all KYC details of each individuals, and you have to give a report saying that, okay, this KYC, he is not a beneficial recipient, then automatically disqualified. So you have to see the percentage, but whether these things are maintained, then only you will be eligible for 0% city. So our workflow, RBS workflow, following on the RBS portal itself, whatever the work you are interacting with the client and our team, it will be interacted through our RBS portal, and you will get a workflow for the entire process, and each stage wise will be interacted with the client and the respective assigned employees. So you will get a real-time status of your work, then accordingly the entire process has been happened. And we are in social media and LinkedIn and YouTube. We have released a lot of free zone, a lot of webinar relating to different city, a different category, like one is this is relating to a free zone part, then initial one city, what is the city impact. All information we have released through our social media. You can just visit our YouTube channel, and you can see our previous webinars, like transfer pricing, then offset of tax loss relief, double taxation, withholding tax, foreign tax credits, and you can see the TP area, transfer pricing, one of the important documentation part applicable for all qualifying free zone. You can see part 1, 2, 3 in the transfer pricing, then qualifying free zone person. You can go through those things.